If you think a few $100,000 in your bank account is a golden ticket to a relaxing retirement, you are walking straight into a financial landmine that most people don't see until it's too late. Intro. Today, we are breaking down the brutal truth about average retirement savings and why the numbers you've been told to aim for are dangerously outdated. Most people spend 40 years of their lives trading time for money, operating under the comforting assumption that saving is enough. They look at a figure like $500,000 and think it represents a life of leisure, travel, and security. But let's look at the actual math that the financial industry often glosses over. When you factor in the relentless erosion of purchasing power due to inflation, that $500,000 nest egg starts to look incredibly fragile. If you follow the traditional 4% withdrawal rule, $500,000 only provides you with $20,000 a year. Let that sink in for a moment. After 4 decades of hard work, the average success story results in a monthly budget of roughly $1,600 before taxes. In today's economy, that barely covers basic rent and utilities in most developed cities, let alone healthcare or the lifestyle you actually dreamed of having. We are currently witnessing a silent crisis where the average person reaches the finish line only to realize they didn't run a long enough race. The gap between having savings and having financial independence is widening every single day. We aren't just talking about a minor shortfall. We are talking about a systemic failure in how the average individual calculates their future needs. To understand why this is happening, we have to look at the median savings across different age groups, which paints an even darker picture. Most people aren't even hitting the $500,000 mark. They are finishing with a fraction of that, entering their most vulnerable years with a financial shield made of paper. This isn't just about bad luck. It's about a fundamental misunderstanding of how wealth must be structured to survive a 20 or 30-year retirement. We need to peel back the layers of the average retirement plan to see where the leak is. To understand why the average person is struggling, we have to stop looking at the average and start looking at the median. While the average retirement savings might look okay on paper because a few millionaires skew the data upward, the median, the middle point of the population, tells a much more terrifying story. For those approaching retirement age, the median savings often sit well below $200,000. This means that half of the population is heading into their 60s with less than 2 years' worth of a middle-class salary. Why is this happening? It's the lifestyle creep and the interest gap working in a deadly tandem. People spend their 30s and 40s upgrading their cars, moving into bigger homes, and financing a life they can barely afford, assuming that their peak earning years will eventually fix the retirement problem. But wealth isn't built in your peak earning years. It's built by the compounding of your early saving years. By the time the average person realizes they are behind, they no longer have the most powerful asset in finance: time. They try to play catch-up by taking massive risks in the stock market or falling for get-rich-quick schemes, which usually results in losing the little capital they had left. Furthermore, we have to address the invisible tax, known as inflation. If you have $500,000 today and inflation averages 3%, in 20 years, that money will only buy what $275,000 buys today. You aren't just fighting your bills. You are fighting a currency that is losing value while you sleep. The average person calculates their retirement based on today's prices, but they will be living in tomorrow's economy. This failure to account for the future cost of living is why so many retirees find themselves forced back into the workforce just to keep the lights on. They didn't plan to fail. They just used a map that was 30 years out of date. We have to look at the structural flaws in the Save 10% rule and why that old-school advice is now a recipe for poverty. The reason the average person is falling short is that the rules of thumb we've been taught for decades are now fundamentally broken. For years, the standard advice was to save 10% of your income, put it in a 401k or a basic savings account, and let the market do the rest. But this advice was formulated in an era when pensions were common, healthcare was affordable, and housing didn't consume 50% of a young worker's paycheck. Today, relying on a 10% savings rate is like trying to put out a forest fire with a water pistol. The math simply doesn't add up anymore. When you consider that the cost of medical care in retirement is projected to exceed $300,000 for a couple, your $500,000 nest egg is effectively halved before you even buy your first bag of groceries. The average person treats retirement as a static destination, but in reality, it is a moving target that is accelerating away from them. This is where the multiplier effect of debt becomes a secondary silent killer. Most people enter their 50s still carrying a mortgage, car loans, or even their children's student debt. They are trying to build a reservoir of wealth while their pipes are leaking from every joint. You cannot build a sustainable retirement on a foundation of debt, yet the average person does exactly that, hoping that their home equity will magically save them. However, you can't eat your house. Downsizing in a saturated market is not the guaranteed windfall it used to be. The transition from earning to burning capital is a psychological and mathematical shock that most are unprepared for. We have to stop thinking about retirement in terms of a total number and start thinking about it in terms of cash flow. If your assets don't generate consistent, inflation-adjusted income, you aren't retired. You are just on a very long, very stressful vacation that you can't afford. Perhaps the most dangerous mistake the average person makes is over-relying on government safety nets and social security systems. We have been conditioned to believe that as long as we pay into the system will take care of us when our working days are over. But if you look at the demographic shifts occurring globally, that promise is starting to look more like a mathematical impossibility. With aging populations and a shrinking ratio of workers to retirees, Social Security was never designed to provide a comfortable lifestyle. It was designed as a floor to prevent absolute poverty. Yet, the average person treats it as their primary retirement pillar. When you combine a modest Social Security check with a depleted savings account, you are left with a survival-level existence, not a retirement-level lifestyle. This is the stage where the wealth gap becomes a canyon. While the wealthy are investing in assets that benefit from inflation, like real estate and diversified equities, the average person is holding their wealth in depreciating assets or low-interest savings accounts. They are playing defense when the economy requires them to play offense. This lack of financial literacy regarding asset allocation is why two people can earn the same salary for 30 years and end up with vastly different outcomes. One understands that money is a tool to be deployed, while the other treats it as a commodity to be hoarded. The average person is afraid of market volatility, so they stay in safe investments that barely keep pace with the cost of living. Over 30 years, that safety is actually the riskiest move they could make, because it guarantees a loss of purchasing power. To truly survive the coming decades, we have to shift our mindset from being savers to being owners of productive assets. Without this shift, the average person is essentially gambling on the hope that the economy won't change, which is a bet that historically no one wins. Even if you manage to save more than the average person, there is a looming shadow that most financial calculators fail to accurately predict: the skyrocketing cost of healthcare. For the average person, a medical emergency in their 70s isn't just a hurdle, it's a total financial reset. We often think of retirement as spending money on cruises and hobbies, but for a significant portion of the population, the largest checks they will ever write will be to hospitals and long-term care facilities. The statistics are jarring. A healthy couple retiring today at age 65 can expect to spend hundreds of thousands of dollars on healthcare costs throughout their retirement, and that doesn't even include the possibility of needing a nursing home or assisted living. These costs are rising at a rate that far outpaces general inflation, meaning your safe withdrawal rate is being eaten alive by insurance premiums and out-of-pocket expenses. This is the hidden drain on the average person's wealth. Because they didn't account for the physical toll of aging, they find themselves house-rich but cash-poor, unable to afford the care they need without liquidating their remaining assets at the worst possible time. Furthermore, the psychological impact of seeing your life savings dwindle due to health issues can lead to frugality paralysis, where retirees are too terrified to spend a single dollar on enjoyment, effectively living a life of poverty despite having money in the bank. This isn't just about having a high balance. It's about having a strategy that accounts for the inevitable decline of the human body. The average person plans for their best-case scenario, living a long, healthy life, but they fail to hedge against the most likely scenario, which involves increasing medical dependency. To protect what you've built, you have to look beyond simple savings and understand the role of specialized insurance. The crisis of the average retirement isn't just about numbers. It's about a psychological trap that catches people in their final working decade. When the average person reaches their 50s and realizes that $500,000, or whatever they've managed to scrape together, is insufficient, a dangerous phenomenon occurs: the Hail Mary investment. This is the point where fear overrides logic. Because they feel they are behind, they start chasing high-risk returns in volatile markets, cryptocurrencies, or in proven business ventures. They stop being investors and start being gamblers, hoping for a miracle to bridge a 20-year savings gap in just 5 years. More often than not, this leads to a catastrophic loss of capital at the very moment they can least afford it. This late start panic is a direct result of the linear thinking most people apply to their finances. They assume that if they work harder and earn more, they can fix the problem later. But wealth building is not linear, it is exponential. By ignoring the power of compounding in their 20s and 30s, they have essentially cut the legs off their own financial future. Even if you earn $200,000 a year in your 50s, you cannot easily out-earn the person who invested just $5,000 a year starting in their early 20s. The average person spends their life working for money, but they never learn how to make their money work for them. They remain in the labor trap, where their income is tied directly to their physical presence and time. Once the ability to work fades, their income vanishes, leaving them entirely dependent on a finite pile of cash that is constantly being attacked by taxes, inflation, and market shifts. To break out of this cycle, one must stop thinking like a consumer and start thinking like a capitalist. You have to realize that your current lifestyle is the biggest competitor to your future survival. Most people choose a comfortable today at the expense of a desperate tomorrow, simply because they cannot visualize the person they will be in 30 years. The reality we've discussed is grim, but it is not an inevitability. The reason the average person retires broke is that they follow average advice and maintain average habits. If you want to escape the retirement trap, you must deviate from the herd. The first step is to stop aiming for a savings goal and start aiming for income replacement. You need to build a portfolio of cash-flowing assets, whether that is dividend-paying stocks, real estate, or a scalable side business that can pay your bills regardless of what the stock market does on a Tuesday morning. You must become aggressive about your financial education today, not when you hit 60. The average person waits for the government or their employer to save them. The wealthy person realizes that they are the only ones coming to their own rescue. Start by auditing your current trajectory. If you continue at your current savings rate, where will you actually be in 20 years? Be honest with the numbers, even if they scare you. Use that fear as fuel to cut the unnecessary lifestyle creep and pivot those funds into productive investments. Remember, every dollar you spend today on something you don't need is a dollar you are stealing from your future, older self. Retirement isn't an age, it's a financial state. You don't retire when you turn 65. You retire when your passive income exceeds your expenses. The average person will keep scrolling, ignore these warnings, and hope for the best. But you are here because you want more. You have the information, you see the math, and now you have the responsibility to act. Don't let your 40 years of hard work end in a struggle for survival. Break the cycle, start building your legacy engine, and ensure that your golden years are actually golden. If this breakdown opened your eyes, hit the subscribe button